Good morning and welcome to Charting the Markets on Monday, the 9th of October. Heightened tensions with regards to the Middle East over the weekend have led to the oil price spiking by about 4% and the gold price also rising quite strongly. And equity markets selling off, and we saw that in Asia this morning. We had Chinese equity markets sell off after last week's Golden Week holiday. But the session in the European markets this morning, which also started off on a negative footing, actually turned into a stable market, and I'll talk more about that in a minute. But before I do, I'd like to mention that on Friday, after the much stronger than expected non-farm payrolls data, which came out for September, adding 336,000 new payroll jobs to the US economy, at nearly twice as many as was expected, around 170,000, has led to the view that basically the US economy is stronger than was thought, and that the risks of a recession are pushed back. And on the back of that, after a lot of selling that had been seen over the last 2 weeks, equity indices actually ended the day on a higher positive note, even if they did still end up the week on a negative footing. But if we look at the FTSE 100 earlier this morning, what we can see here is the sell-off we saw taking us down to 7,471 on the daily financial bed. But as I've just said, since then, we've actually managed to rise above Friday's high here on the back of the stronger oil price, which helped the FTSE 100 constituents such as BP and Shell, for example, rise. And also as risk on sentiment is re-entering the fray with hopes that there is not going to be any greater escalation with regards to the Israel, the Gaza Strip conflict, with hopefully the US and Iran not being dragged into a wider war in that region. And on that hopes, the FTSE 100 has managed to rise so far. Now, obviously, the situation is still ongoing and very volatile. But what we can see here from a technical perspective is that we've managed to rise above the orange line, the 55-day simply moving average, 7,519. And the fact that we rose above Friday's high is also positive, both of which means that if things do not worsen with regards to the situation in Israel and in the Gaza Strip, then we could perhaps see a further advance in the FTSE 100 over the course of this week, take us to the 10th of August high at 7,624, and the red line here, the 200-day simply moving average at 7,650. And this view will remain in play, provided we stay above last week's low at 7,384, and also the September low at 7,369. So for me, this is the key support area of the FTSE 100. As long as we're above it, we can actually regain these losses we've had over the last 2 weeks and head back up towards the 7,700 area from a technical perspective, purely. With regards to the DAX 40, the situation is quite similar in that last week we dipped down to 14,944, and that was a level last traded back in March of this year, before we managed to rally with the help of the US markets on Friday, as you can see here, with a very positive close. And obviously this morning with the Middle Eastern conflict here, we had a much lower open than a pretty stark sell-off, take us down on this daily financial bed to 15,079. And now we're trying to regain these losses, but we will have to overcome not just the September to October downtrend line at 15,242, but also Friday's high at 15,296 for us to be able to head back up again towards this key resistance area made up of the July to September lows between 15,455 and 15,561. But as I've said, Provided we stay above 14,944 from a daily chart closing basis, I expect further upside to be seen, because we saw that the latest low we made last week here at the beginning of October was not accompanied by a low reading of the relative strength index, the RSI, which actually made a higher low. This is called positive divergence, and it does normally lead to a correction against the major trend, which in this case is down. And also from an elliott wave perspective, I expect this decline we've seen since August and July of this year to be an A wave, then we have a B wave, and then we have a C wave. So the ABC correction might have ended last week, in which case we could be heading all the way back up again towards the 16,000 area with regards to DAX 40. Now, of course, a lot will depend on the outcome of geopolitical tensions in the area around Israel and in Israel, and also whether the oil price will come down again from its earlier rise we saw earlier this morning, or not. If we now look at the S&P 500, what we can see here is a similar story, in that on Friday, on this much stronger than expected non-farm payrolls data, which, by the way, was the highest jobs number we saw since February, and it showed that the US economy added net jobs for 33 consecutive months on that much higher than expected reading, the S&P 500 went back down again to this key support area I've been mentioning for the last few weeks, between 4,240 and 4,187, the early and mid-May highs. And once again, this support area has held together with the red line here, the 200-day simple moving average, and we managed to rally and not quite reach this key resistance area, which is made up of the June to August lows and also the late September high between 4,328 and 4,337. Actually, you could say that that resistance area goes all the way up to the 10th of July low at 4,378. So that will be a difficult area to overcome for the S&P 500. But again, here you can see this potential ABC corrective move, and we've held at the 200-day simple moving average now 3 days in a row here, or actually for 3 days, not quite in a row, but all of that is actually quite positive short term. But we need to take out the high seen at 4,333 on a daily chart closing basis, and ideally also rise above 4,378 for a bullish reversal to become possible with regards to the S&P 500. The US dollar has last week finished its 11 straight weeks of gains and didn't quite manage to make a 12th straight week of gains. And you can see this here on the US dollar basket. And what we can see here is that we have actually come off our 106.97 high and fell back down to the lower uptrend channel support line here on Friday at 105.60, which has actually held so far. And since then, we've had a spike back in the price of the US dollar. Not a big spike, though, on these flight to safety flows into US dollar as a safe haven currency because of the Middle Eastern conflict surrounding Israel at the moment. Now, if we were to remain below Friday's high, which I believe is quite likely, and that was made at 106.62, then the odds are actually stacked in the favor of the short-term bears, because it could mean that we could fall through last Friday's low at 105.60 and then retest the late September low at 105.29. Failure there would mean that the top is in place, because after all, what we're seeing here is negative divergence. That is to say, the high we made at the beginning of this month has not been confirmed by a higher reading of the relative strength index down here. So that's called negative divergence, and it quite often leads to reversal in the trend, or at least a sideways trading range after a previous trend. So short term here, we could be topping out with regards to the dollar index. And if you look at the euro dollar, which makes up, the euro makes up 57.6% of the US dollar basket, you can see the inverse of this happening. And here what we did, we bounced off this 104.60 low, which was made right between the beginning of December and beginning of January lows, between 104.84 and 44, a key support area, and also the bottom of this downtrend channel. And also we saw here positive divergence on the relative strength index. And all of that took us up to Friday's high at 106. Now this, and also the late September high at 106.17, would need to be taken out and exceeded on a daily chart closing basis for us to form a reversal pattern here. and to be able to rise back up towards the 200-day simple moving average here in red towards 108.26. So this hasn't happened yet, but the possibility still remains in play as long as this key support area going back down to 104.44 keeps on holding and keeps supporting euro dollar. And the story is quite similar with regards to the British pound against the US dollar. What we saw here is also positive divergence. As you can see here on the relative strength index, we had a higher low made on the RSI, yet we had a lower low made on the cable chart here. We did so at 120.38, that was last week's low, made marginally above the psychological 120 mark, and we didn't quite reach the late September high at 122.71, which now needs to be taken out on a daily chart closing basis for us to be able to head back up again towards the July to October downtrend line, and also the red line here, the 200-day simple moving average, 124.40. So from a technical perspective, provided we saw Friday 121.06, it is quite possible that we may actually see this bullish reversal to the upside in the next few days and unfold. Now, what I would like to also talk about today very briefly is the US dollar against the Canadian dollar. And what we saw there last week is a rally to levels last traded back in March of this year to 137.85. But that high then was followed by a very sharp reversal, taking us back down to today's low at 136.40. And that was on the back of this Middle Eastern conflict that is ongoing at the moment, and also therefore the oil price spiking higher and aiding the Canadian dollar versus the US dollar, the higher oil price that is. So what you can see here is that these lows we made today, again after Friday's lows, were made where the April and May lows also come in. They currently offer support. If we were to fall through these levels, then we could slide further towards the 136 area or so in the next few days. But to me, it looks as if we are in the process of forming a top here, because again, what we can see on the daily financial bed chart is that the high made in early October above the high in September, that high has not been confirmed by a higher reading of the relative strength index, which is here showing a lower high compared to the one we made back in September and August. So there is basically some negative divergence going on, slight one, but still it is possible that the currency pair will actually revert lower in the next few days. The consolidation in the US dollar after 11 consecutive weeks of rises has helped some commodities to rally, but far more importantly was the Middle Eastern conflict surrounding Israel, because that led to the price of crude oil shooting up by about 4% over the weekend, as you can see here on this daily financial bed chart. And we so far earlier this morning rose to $86.11. And last week only, we were trading around $5 lower at $81.21 per barrel. You can see this doji formation here on the daily candlestick chart. Now, what is interesting is that we didn't have any follow through above $86.11 earlier this morning, but instead we fell back down to the orange line, the 55-day simple moving average at $84.32, and are trying to close the price gap with Friday's high, and that was made at $82.34. So as long as the situation in Israel doesn't escalate, and more importantly, as long as other players such as the United States and Iran don't get involved in the situation there, and Hezbollah hopefully not adding to the fuel to the fire by bombarding Israel with further rocket attacks and Israel retaliating, as long as all of that doesn't really escalate, the price of oil could actually close this gap here going forward, and provided we stay on a daily chart closing basis below today's high at $86.11. Now, if that were to be the case, in that scenario, it would show us that even though there are these heightened geopolitical tensions in the Middle East, the oil price does not continue to shoot back up to its previous highs. And that would, to me, indicate that we could actually be heading back down again once we've taken out the $81.21 low from last week and fall towards the August lows and the 200-day simply moving average here between $77.60 and 45 cents. So that is a possibility if we were to close this price gap. Now, if that weren't to be the case, and if tensions were to heighten with regards to Israel, we could see a move back up again towards the late September low at $87.85, and perhaps even the psychological $90 mark. The price of gold has also rallied very strongly on this Middle Eastern conflict, and we can see a big gap here forming so far between $1,835 per troy ounce, Friday's high, and today's intraday low at $1,847. Now, here, not much is happening. I think investors in the gold price, I should say, excuse me, are basically awaiting what is going to happen with regards to Israeli ground troops. Are they going to invade the Gaza Strip or not? Is there going to be an increase in tension in the region or not? And basically, whilst everybody's holding here, the price of gold is not doing much. Now, if the situation doesn't escalate, I wouldn't be surprised if the price of gold were to slide back down towards Friday's high in order to close this gap at $1,835 per troy ounce. But if there were heightened tensions, then we could head back up again towards the lows seen back in June and also in August of this year between 18,885 and 18,000. Sorry, I should say $1,885 per troy ounce and $1,893 per troy ounce. So that is a possibility. But right now, we're just in no man's land, not much happening, volatility really dropping off dramatically. And last but not least, I also like to mention the silver price, which has also spiked higher on these geopolitical tensions in the Middle East to this morning's high intraday at $22.01. But since then, we have actually practically closed the price gap with Friday's high at $21.62. So here the gap has been filled. And the question now is whether further downside is in store. In that case, it could lead to the low from the high from Wednesday of last week at $25.41 being retested. And provided we stay below today's intraday low on a daily chart closing basis, $22.01, further downside seems to be likely to be able to take perhaps the silver price down towards the psychological $20 mark or so. So that is the reasoning here, basically being that we are seeing a series of lower lows and lower highs, which is still the definition of a downtrend. Now, if we were to see further upside with regards to silver price, there is a pretty big resistance area here coming in between the June lows to the September lows between $22.12 and 30 cents. Thank you very much for watching Charting Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter. My handle is @AxelR_IG.